Welcome to the Dorsey Report. You can read more at Google Sites, StockTwits, and Twitter. Today's report is midweek, January 14th, 2015. And we're going to be going over our midweek economic reports, what's good, what's bad. Look at how the S&P 500 chart is starting to turn up. And long bonds versus stocks, has anything changed? Looking at Russia versus Canada, interesting play there. Bad Apple. What are the prospects for everybody's favorite tech stock? And wrap up with a volatility forecast. And as usual, if you like what you see here, please like, share, and subscribe to my channel. Thanks. Alright, so far we've only had one major economic report, which was disappointing. Looks like retail sales did miss quite a bit, down 1% with a 0.1% forecast. Both the core and the regular number missed. We've got two more big reports coming out, actually three big reports coming out tomorrow, Thursday. We've got the New York Empire State Manufacturing Index, the PPI for producers or purchasing managers, and the Philly Fed Manufacturing Index. And that's going to be the key one, expecting 19.9. We'll see what actually happens. But even more important than that, as I've been talking about earlier in this week, we've got Coach Lakota speaking for the second time this week, and followed up by Bullard. So double Fed speaker whammy on Friday. We'll see. There's always a chance another central bank speaker comes in and says something bullish, but DI is still expecting some type of a central banker surprise. So we'll see what happens on that front. Looking at the 30-minute S&P 500 futures chart, we are seeing some very positive developments here since about earlier this afternoon. Looks like the S&P 500 has managed to push well above our key June lines here. At about 2006, 2007 was the key level that we wanted to punch through, and so we've had several half-hour and also hourly closes above that now. Also, we still have our long bonds, Coke, and high-yield bonds and the US dollar yen cross, all pointing quite a bit higher, as well as our MACD histogram bar is printing far above the previous one. So lots of signs of strengths here. RSI is at 57.5, flattening out a little bit, kind of flirting with 60, but we're still above 55, so just waiting for that to tick above 60 to really get things going. And we are well into a positive Ichimoku phase, so all clear on the 30-minute futures. On the 2-hour S&P futures, we are still looking a little bit weak here. RSI is still down below 50, and we've yet to clear some of our key June levels here at 2023. Also, we've got the 33 EMA up there, and our 20 MA for the Bollinger Bands at about 2018. So we really need to push up through those low 2020s. On the 2-hour interval to get more of a 1-week range bullish kind of forecast. But so far we have put in some convincing bottoms here, and we're just waiting for things to kind of transfer up from that 30-minute and hourly time frames up to the 2-hour time frame. In terms of our epic struggle between stocks and bonds, the U.S. long bonds, as represented by the TLT, are still the clear winner here, although we're getting pretty far extended. Price action far above all of our moving averages here on the daily chart, and our RSI is at 65.8. Even though it is starting to make a series of lower highs here, it's still well in the positive momentum area. Also, another key development on our Google Trends sentiment for the week. So far, our initial print is really low, 58. If I clear out though, you'll see it's far below the last 4 years. So with bonds, that actually is a big buy signal. So definitely something to keep in mind there, even though it is only a provisional print for the week and we have to wait a few days for that to be secured. Looks like you can keep on buying bonds. On the interesting intersection between international emerging markets and oil, big story coming down the pipeline is the Fitch downgrade of Russia, assuming $70 oil for 2015, which might be generous, who knows. Anyways, definitely not recommending to get involved with oil at all, but there is an interesting trade in Russia, because whenever any of these major credit rating agencies like Fitch, Standard & Poor's, Moody's downgrade a sovereign, it's almost always a contrarian indicator. you'll actually see their debt start to strengthen and then their equity markets start to strengthen. So when you see Fitch downgrading Russia, and you can see by the response here, they're expecting Russia to fall into a deeper recession from negative 1.5% GDP down to negative 4%, and yet Russia is already responding with Paul Volcker-like interest rate hikes up to 17% from 10%. So some tough medicine, but it looks like they also raised their insurance deposit caps by double, which is almost like a FDR, Great Depression level measure. So Russia, it looks like, is really taking this very seriously. Nice contrarian indicator there with the downgrade. And how you would set this up, which is interesting, is against Canada, actually. We see our price of production here, nice little chart. Russia is kind of in the $40 to $45 range. Over here, we've got the Canadian tar sands pushing $90 a barrel to produce. An interesting thing about Canada is they are a very commodity-driven market. Big part of that is energy, and they never had a pullback in their real estate markets. As you can see here, their household debt to income, U.S. peaked around 2006-07 during the Great Recession, pulled back towards 100%. Canada just kept on trucking. They're well above 160%, which is very unsustainable. And so you'll see their stocks have been getting pounded. They're pulling back over time. People are taking their houses off the market. Things are just not looking good for the Canadian markets. So I think investors should be focusing more critically on Canada than Russia. And kind of the ultimate arbitrator here, we've got the RSX ETF representing Russia and the EWC representing Canada. And as we can see here, we've had kind of a critical break above shorter-term moving average. Looks like things are starting to turn up. And we're definitely having a very nice series of higher lows here on the RSI. Right now, just pushing 51, so a little bit more work to be done on the upside. But it does look like there's some prospects, and this one is really tantalizing because if we do have a move up here to converge with the 200-day moving average, that's a 29% move, just going long Russia via RSX and short Canada via EWC. So interesting trade there to keep an eye on. Some of you who are following me on StockTwits may have noticed that I've recently gotten bearish on Apple just because it's really starting to slide down the relative assets and sectors here. It's ranking at 24th of 30, below the 50-day moving average. RSI is 47 and dropping, and it's really outperformed on the quarter, so I see quite a bit of downside here. What's really got me convinced on Apple is actually just sentiment and positioning across the board. One of the big indicators here that works on almost any stock is Barclays came in here and raised their price target from 120 to 140 back in December, and you know, what do you know? Apple peaks out just below 120 right around then, and this is classic Barclays. Whenever they raise their price target or lower it, the opposite ends up happening. So we are seeing Apple definitely correcting here, kind of flirting, back testing its moving averages, but that's a classic move. Definitely expecting lower, probably a test of the 200 moving average here, down around 97 it looks like. Another big tip off is Apple is one of the most rated stocks here. 88% positive analyst ratings, which again is a big contrarian sign. Just not something you really want to see. It looks like the median price targets also are up 18%. So, you know, whatever these guys are doing, in aggregate, they're just not giving good intelligence, not giving good advice. So this is also bearish for Apple. In terms of StockTwits sentiment, we're at 85% bullish and only 15% bearish. That is just not sustainable. So another demerit. And then another more technical, kind of structural. On the option side, we're looking at the February 2015 contract, so the next monthly contract, and we've got big open interest on the call side of things, almost 142,000 versus 43,000 puts. That's over a 3-to-1 ratio at the 120 strike, also over a 3-to-1 ratio at the 110 strike. So you know those are not happening. People are very willing to sell their Apple at those two levels. and we're not really getting down to a 1-to-1 until, what do you know, our 97 target, where we finally have a large concentration of puts here between 95 and 100. So we might start seeing some buyers there, but that's going to be a big move lower for Apple. So I can officially say that Apple is a short here. So if you do have any Apple, you might want to think about getting that thing hedged or raising some cash. And finally, we have our VIX forecast. We are now pushing our 11th day above the 33 EMA. Big black candle today, which isn't necessarily a sign of a top, but we're still maintaining our series of lower highs. We're same thing on the MACD histogram, printing lower histogram bars here. And looking at our probability chart, it does look like we're starting to push up into the lower probability zone here. 2 more days and we'll cross below the 50% threshold. Even though we are in the month of January, we could definitely push this thing out another week. It does look like elevated volatilities days are definitely getting numbered here. Typically, you want to be selling volatility on days 9 through 16, and we're about to be at day 12 as of tomorrow. So take that with a grain of salt. As always, thank you for watching and listening, and I always appreciate shares and feedback. And until we speak again, good hunting.